Well, thank you all for coming this morning. And we asked Jack to come because basically the overarching theme for government affairs this year is going to be advocacy. We're in a non-election year, thank goodness, because last year was quite the doozy. So we're going to take this time to rethink and regroup and figure out what we do and how we do it when we do advocacy at the local level, at the state level, and at the national level. And it's all based on basic principles, which is why we have pocket constitutions and declarations of independence for you. Because let's start with the basic principles, and that's where we build from. So with that, thank you for coming, Jack. It was very nice of you to come all the way from DC for us.
Yeah.
So let's start with a really broad, big background question. How did you end up in advocacy for NAR?
Largely by accident. You don't know anybody that actually woke up one day and decided to go into politics. That is a misnomer. People do not wake up deciding they want to do that. I was actually in college, just wound up taking a class, political science class, and had the requirement of actually needing to work in an elected official's office as a volunteer. As a young 19-year-old kid, not knowing the hubris of what I was doing, I picked up the yellow pages, went to the top of the elected officials page, which is a U.S. senator, and made a phone call. And a week later, I was an intern in a U.S. senator's office. So it was just by chance. In a lot of the same way, I went through most of my life just kind of figuring it out on my own and got very lucky in some of my efforts. And one day wound up working for the Florida Realtors. Spent about 10 years working there, and inevitably found my way to your side of the world to figure out what it was you all did. Did franchise sales for a year and decided I was not suited for your world, but respect a lot of what it is you all do in even greater detail than I did before. And when I decided I wanted to come back to government, it just so happened that one of the positions was open at NAR. And so having a long history of working on your behalf and loving what you all do and representing you that way, made a quick phone call, and was my boss at the time was very gracious in allowing me to come work for NAR. So I've been there a little over a year and a half now, but in total probably working on your issues for more than 12 years now.
Great. So can you describe your job, your duties, how you interact with the NAR advocacy team in DC, and then how you interact with members?
Yeah. So the best place to start here is a clear understanding of what advocacy looks like in NAR, and there are really two segments. So you have our true lobbyists, the people who work 100% of the time with Capitol Hill, and there's a team of those individuals, and they head up all of our policy efforts, working with our congressional leaders and our agencies. So that group spends all of their time in DC. And then there's another half, and that's my team, and we are the political directors. And we have, right now, I have 20 assigned states because we're down a couple of people, but we will, scale back up. And our role is to not only work with Capitol Hill and work with our elected officials, our senators and our congressmen, but to also work with you all in making sure that you're fully aware of the issues that we're working on, how those issues are, we believe, going to impact your industry, and then ultimately engaging you in not only be involved in your communities to go out and talk with members on their behalf, meaning your association, but also to engage your congressional leaders on the things that you all can do to effectuate change in your marketplace. And so, a lot of times when I get a phone call from a congressional leader about your area, the number one thing I need to come up with is who is the right person to call and contact so I can give an anecdotal experience to your congressional leader to then go on the floor of the House or the Senate and then talk about your experience and how this bill is going to affect you, the language, the nuances that people just don't think of. I think when you talk with government affairs professionals, the one thing that we all agree upon is legislation in itself is not bad. It's the unintended consequence that we didn't think of in the process that we wind up having to deal with and have to work with. And number one, that's probably what I'm seeking every single day. Who's that person I can call? How's that work? Now, to the other part of your question about what are my specific duties, when I say it's working with you, it's working on all things related to advocacy. So it's not only educating you about the issues, engaging you on your congressional leaders, but doing, the yeoman's work and the fundraising side, going out and making sure that the people in this room are carrying our message to brokerages and agents and other offices, making sure that they understand that the importance of what we do as an association and the bipartisan nature in which we do it elevates you amongst every other association nationwide. The fundraising vehicle that which drives all this, RPAC, the importance there and the contributions that we need to come in that make this machine move the way that it does. ultimately I have a role in all of that, trying to assist you in those ways.
So some of you may have interacted with Maggie Fitzgerald last year. Jack is now our representative. Maggie went on to another job at another company, and Jack has only been with us in this position for what, about 17 days, I think, officially?
Something
So
like
we're very lucky he was able to clear his schedule and come to us because he does a lot of work across a large part of the country. How many states do you
I cover
interact
20
with?
states in, basically start in Massachusetts, skip down to Delaware, run straight across Delaware all the way over to Colorado, and now all the way down here. So Nevada, Arizona, Midwest, I cover Louisiana. It's basically, funny joke, we have 3 strips. The upper strip of the continental US is my colleague Zach. We actually refer to him as the King of the North if you're a fan of Game of Thrones. I have pretty much the entire central region, and then all of the states with probably like the most outspoken members of Congress, California, Texas, Florida, and the Southeast, is our colleague April.
Wow.
So
Yeah.
big strips, lots of work.
And what's the favorite part of your job?
What is my favorite part of the job? Honestly,
Besides visiting airports.
yeah, besides visiting airports and staying in hotels, right? I think the favorite part of my job is making sure, and this goes back to what I was working in the U.S. Senator's office, there is a lot of nuance to government. And I think, the expectation of government is government works, and government is like this technologically advanced, hyper-functioning entity. It's not, right? Like, it's not. That is a complete misnomer. Working through the process, making sure people understand where the right person to call, making sure that people are getting answers, that's what I really enjoy doing. And, you all are focused 100% of your time on working in real estate, as you should. I'm focused 100% of my time on working on politics, understanding the nuances of what's going on between the Democratic and Republican parties, understanding what's happening in these particular races, where we're going to have challenges, where we can engage, and also, more importantly, learning about your communities and figuring out where to go. By helping you all find the path to get answers to your questions, that's where I find the most enjoyment, because ultimately we're doing what we're supposed to do. Government is functioning the way that it should. And so that ultimately boils down to why I love my job.
Great. So we're going to go into the hot topic for some of our members, which of course is the November elections. And in our neck of the woods, I got a lot of calls and emails and stops in the hallways from members saying, why is NAR backing Senator Sinema, now Senator Sinema? Why aren't we backing Martha McSally? Why are we even engaged in this? It's such a close race, and in Arizona it's so contentious. Why are we even weighing in on it?
Yeah.
So can you address sort of the idea of, first of all, why does NAR weigh into races like that? How do they make the decision what race to weigh in, and how do they figure out who to back or not back and why?
Yeah, absolutely. So let's think about this for a second. So ultimately we're an advocacy association, right? We have issues that we are trying to engage elected officials on, and elected officials are going to engage on those issues, in hopes largely because of the feedback that they're getting from their constituents. To the specific point of, members having commentary of whether we should or we shouldn't be involved, we get this uniformly across the country, right? And we're always going to. And there's never a right or a wrong answer to whether or not we supported a candidate and we won or we lost. And, ultimately our decisions, when it boils down to who we support, ultimately boils down to how supportive they have been of our issues. And so, quite simply, when we talk about just the anecdotal example of Martha McSally and Kirsten Sinema, now who are both senators in your state, the interesting thing boils down to their records, right? If you look at their voting record, right, starting off, they have virtually the exact same voting record, largely supportive of our issues, fantastic. They've got a couple of issues where they may have voted against us on a particular position that we had with a particular bill. But where the nuance really comes into it boils down into all of the things they're doing outside of congressional voting, right? So every time they're not pressing a button, what are they doing on our behalf? And the records are just plain as day, right? Martha McSally didn't really do a whole lot for us beyond the votes that she cast. She wasn't co-sponsoring legislation. She wasn't signing on to letters. She didn't have positions on key committees that offered her opportunities for key votes. Where on the other hand, you have Kirsten Sinema, who very clearly had a long record of supporting our issues in committee. She had a long history of signing on to letters for issues that we were supportive of or objective of. And then in addition to that, she also went ahead and co-sponsored just an enormous number of bills that we found important to our industry. And so when you look at that, to make this more, I think, or to give a good example for you all, it would be to put Liz and I in a position of we're realtors and doing business with you. Every time we vote in your favor, that's a closed deal where you wind up getting paid. But Liz, on the other hand, is sending you referrals and she's sending you business where Jack isn't doing that, right? Who are you going to give your business to? You're obviously going to give it to Liz. When those types of things come up, we have to look at it the same way. These individuals are supportive of your industry. They're going ahead and doing the work for you in Congress and being a voice that we're supportive of. We have to go to bat for them. And so ultimately, looking at these races, we have to make decisions. Do we go ahead and do we support a Realtor Party champion, or do we stay out? Had their voting records just been the exact same and on both sides, nothing had been done by either one of them, yeah, it's very clearly stay out, let the state figure it out. You can make that argument. That's an easy way to do it. But when you have a realtor champion there, when you have someone who's backed you the way that Kyrsten Sinema did, now we have to go ahead and we have to engage. The interesting conversation to be had now is Kyrsten Sinema now sits on Senate Banking. Martha McSally sits on Senate Banking, okay? How do we turn Martha McSally into the realtor champion? Because Martha McSally only has a 2-year appointment. So in 2020, she's going to run for a re-election. And our hope as an association is that we can get her to engage on our issues. Now she's on a key committee. She's a senator for your state. It would be something that we would love to get involved in. And so that's the new conversation that even as of last night, Liz and I were having. It's like, what do we do, right? And we now have to start getting very creative. And again, Martha McSally has already been a champion. We don't anticipate this is going to be a hard lift, but that's what we're looking ahead towards.
So along that line, one of the things I heard from some of our members was, is there any way during that deliberation period that NAR goes through when they're evaluating who they're going to support or not, is there any way for members to send a note, an email, and say, hey, you may not be aware of this, but this is what this person did, this candidate did for us here in the state? Because some people felt like Martha McSally in state was doing and providing them services and help that you may not have known about. So how does that happen?
Yeah. So let's talk about the process that we go through for coming up with our decisions. Ultimately, the recommendation does start on the staffing side. Just as you all would look to Liz to talk about your local engagement, whether it be your county or city officials. We look at our record that we see for Kyrsten Sinema and Martha McSally, and how did they vote, how did they engage, et cetera. And then we make a recommendation, and that recommendation comes to the Arizona State trustees, okay? That is your first line of opportunity to have a conversation. So who is your trustee that represents your marketplace, or who is the trustee that sits on the board? Do you have an opportunity to talk with them? Ultimately, they're the ones that are going to approve, amend, or decline our recommendation, okay? And that's where it starts. Now, I would encourage you all to familiarize yourself with who the members are here in your state, on your state trustees, but first start with them. Once that recommendation is made or approved, it comes back up to the federal level, and then a federal disbursement, a portion of the trustees, which are referred to as the federal disbursement trustees, they then go through the recommendations that come back from the state. So again, you could have amended it, you could have changed it, and then they approve it at that level. Once that happens, then it winds up on my plate, and that's when the engagement aspect, where I start going out, coming up with a campaign plan and things like that. When it comes to the commentary, the real question I have to boil down to, and this is where we get into really interesting conversation with members, is, oftentimes when I get phone calls from members about a position of the association, usually the member is calling me with a very partisan viewpoint, which I don't get to have any opinion on, okay? My viewpoint is, how do they enact for your association, period, right? If it's positive, it's positive. If it's negative, it's negative. And that's a really challenging aspect for me to deal with on a daily basis, because, when you're calling me on the phone to tell me I don't agree with, Republican candidate X because, they, voted for Trump's tax plan, right? Okay, I can't do anything with that, right? Like that's not something I can turn into something. However, on the other hand, we had conversations before where someone picks up the phone, someone calls us, and they say, hey, we have had these types of issues with our congressional leaders or our senators. And then they've said these statements publicly or they've taken these votes. It's easier to have that conversation and show some history with regards to being anti-realtor issue. And then that's something we can engage on and we can start to have a conversation. Okay, great, we can consider that, we can look at that. As the Government Affairs Committee, one of the things I would respond to you is, as you all have feedback, even locally, from members that agree or disagree with your position, couch it in that light. How is this person viewing this problem? Are they viewing it in the partisan nature, or are they not? And my hope is that all realtors will view it in the aspect of their business, right? Is this good for my business? If they're not looking at it in that, hey, that's okay, right? We're all entitled to our opinions. We should all go to the voting booth and we should reflect those opinions in our votes. I encourage everybody to do that. But from a staff perspective, we just don't get that luxury, right? We have to, again, base all of our choices on what you all as committee members and, whether at any level, what you all state is our position as an association. And so that's where that all comes from. Now, however, if you don't like it, right, and again, I pick up every single phone call from every member who wants to yell at me about the work that we've done or tell me how excited they are about the work that we've done, call. And I'm happy to explain the NAR position on these issues, or even work with Liz to come up with the Arizona position or the WeMAR position. Happy to talk through those things, but understand my position, regardless of what my political beliefs are, I'm always going to look at it through that lens of your business.
And so that goes to the point that NAR has a legislative policy. There are certain things they look for, and the legislation, the issue has to fit into that criteria. If it doesn't fit into that criteria, then it's not something they're going to address, no matter how important it is. Because one could argue that real estate touches everything. Well, we can't be in everything, so you have to have a tool to narrow that. We have the same thing here at WeMAR. We have a legislative policy. So when we look at local issues, we are looking at it through that lens. When you see endorsements, whether it's through the local endorsements through WeMAR or at the state level or through NAR, I tell members it's one tool. You are a voter. You're trying to make judgments on who to vote for. What you see come out as endorsements or not endorsements because of the criteria we use is just one tool you use in your overall research and looking at that candidate. It's one evaluation tool. And sometimes people don't understand that's what we're giving you is one tool to put into your mix of contemplation. Yeah,
absolutely. And, again, when you all think about that, again, remember it's, I make a recommendation, but it's ultimately members, realtor members who are in the same seats that you're in today, who are ultimately approving those decisions. And same thing for Liz, right? Everything we do, ultimately you're approving. So it's not one-off, Jack decided that we're going to go support Kirsten Sinema or Martha McSally, and it's just Jack's opinion, right? We took this to the members, to your associations, got your feedback. There's a very clear process that's stamped in stone to make sure that something like that could not happen.
Great. So we are going to leave election and candidates and things like that. Let's move on to the ever non-ending project of flood insurance. Which I think has been extended to what, spring, early spring? Yeah, May, okay.
Till May.
So tell us about flood insurance until May. Is there any movement on trying to actually fix that thing?
No. There's just not. There's not, and you have to understand that you have to understand the players, right? So, NFIP has a lot of issues right now. The last two major hurricanes that swept through Texas and Florida put it $22 billion in debt on top of the additional $16 billion that we had from Hurricane Sandy, from Sandy. It's in debt. There needs to be a lot of resolution to the problem. And, resolution to the problem really boils down to changing a number of things. First off, pricing. Pricing is a really big issue, depending on the market that you're in. If you live in New Orleans, right, you are in perpetual underwater territory. You're never going to get back out because, you turn off the pumps, the city's going to flood. If you live in Florida, you live in a hotbed of Hurricane Alley, yet the NFIP program is being utilized by all 50 states. If you actually look at the heat map of where the policies are, it's amazing to see how dramatic it spreads across the country. With that said, we start with pricing. We then have issues with regard to mapping, which I'm sure everyone in this room is probably well versed with. Here in Arizona, you don't have as much, perpetual like static flooding, where water will set and someone's home will flood out, but you do have a lot of flash flooding, and, you build a community and suddenly someplace that sat in a floodplain no longer sits in a floodplain, or someplace that didn't sit in a floodplain now sits in a floodplain. There's a lot of things that we go into here. One of the issues that we have is we don't have very accurate mapping. We've known this for the better part of 10 years. As long as I've been with the association, we've known this. One of the resolutions to trying to do that is LiDAR mapping. And if anybody doesn't know what that is, this is laser mapping from satellites. It's a very expensive process to do, but only a handful of states have actually done it so far. North Carolina being one of them. I want to say Arkansas was another one that had done it. I don't know any others that have fully completed their statewide mapping, but LiDAR mapping would basically give you an accuracy within an inch of your property. And so they could tell you, do you or do you not exist within a floodplain? There are things that we've advocated for, again, these pricing structures, but ultimately we have not gotten there yet. One of the big pieces that we continue to talk about, and I think one of our questions will eventually get here, is actually an incorporation of the private flood market into the National Flood Insurance Program. And there has been legislation proposed to do that. Ultimately, right now, we just can't get consensus. That's the biggest challenge that we have in Congress. They're fighting over other things. Right now, it's the shutdown. So to get consensus on this is going to be a challenge. Moreover, to get consensus on this within our membership is even a bigger challenge. So, if you're in New Orleans, grandfathering is a very important thing because so many of those properties have had severe flood damage so many times in history. Like, it absolutely has to be a part of it. You go to other states and it's different. And, finding consensus amongst our members to agree uniformly, this is what we should have, big challenge. I will say, and this is probably a little bit presumptive, but, one of the things that we have started talking about internally is that when you start looking at the nuances of individual states, Florida started dealing with this a number of years ago, and it's the reason I'm fully aware of it, which is we actually went to the secondary mortgage market and said, okay, hey, what does a private flood policy look like? And what we did was started looking at, if you can mirror what the National Flood Insurance Program looks like, we can mandate that lenders within the state are required to accept a mirror policy, even if it's a private flood policy. And so that offers opportunities to find lower rates in the private marketplace, which you can probably get. There's a lot of concern federally that if you bring private flood market in, they're going to wind up cherry picking. I don't see the problem in that. We don't see the problem in that, because ultimately what winds up happening when you cherry pick is you take some of the good ones, but you also take some of the bad ones, because the bad ones, you're going to be able to charge a higher rate. And the likelihood is if you actually look at an actuarial table, they're probably going to flood less than what people realize. It's just when they do flood, the cost is going to be at a maximum. And so, there's still opportunities to make money there. Ultimately, what we found in our Florida experiences was, the private market came in, they cherry picked, they took some of the good, they took some of the bad, and what we were left with was really the most uninsurable properties, or the highest risk properties. But because there are so many fewer properties in that pool, you can actually take what is Citizens Property Insurance, which is the insurer in Florida, and when a hurricane comes through, has flooding, has issues like that, they actually wound up in the black as of the last hurricane season. And so, it's the anecdotal evidence that everybody's using at the federal level right now to have the conversation on why we should include the private market. It may be a problem that's better solved state by state, where the state goes in, looks at their own anecdotal experience, because insurance is regulated at the state level, and find those solutions that way. We're not there as a policy position yet as an association, but we're having the conversation to see if it's worth pursuing that down the road.
So this is a talking point and a discussion point that keeps coming up because it isn't being fixed. It just keeps being pushed down the road. But NAR, on your website, you have lots of resources.
Tons.
If you want to educate yourself on the history of National Flood Insurance, what it is, what it does, some of the bills that have been in discussion and are still in discussion, you can find all that. So what one or two resources there do you think people should access first?
Yeah, so everybody should familiar yourselves with it. There's really two sites that you should familiarize yourself with. The first is nar.realtor. nar.realtor is obviously our NAR webpage. Go under political advocacy. Under advocacy, you can pull up federal issues. And there's even the 2019 advocacy agenda, which we just recently released 2 days ago.
Yeah, just a couple days ago.
Yeah. And that's a copy of it right here. pull that up. That's going to be the things that we're monitoring. Obviously, we're in a new Congress right now, so all the legislation or theoretical legislation that we have had proposed in the previous years, all has to be readmitted. So, there isn't anything on the docket yet that we're truly paying attention to with regard to NFIP. No one's passed a bill yet. Right now, our biggest concern is making sure that we always get funding. One of the biggest things, and this will help clarify some of the stuff, hopefully, that's happened in the last year, is we've had continuous extensions through continuing resolution, which is actually what has been funding the federal government. We haven't had a budget actually in the last Congress. Right now, what they're fighting over is, again, another continuing resolution that will fund the government through the remainder of the fiscal year, which would be September of 2019. We have funding through May. One of the biggest issues we're always concerned with, and it's the primary thing you all should pay attention to, is now that NFIP has been extended through May, if they pass a continuing resolution through September, it means that we have been decoupled from the budget, right? With the extension of the budget, we always know we're going to get funding for NFIP. If they decouple it from the budget, now you're arguing over funding for NFIP. Some people say it's the key to help forcing legislation through. We don't think that's the case. We want to ensure that it should always be there, right? We as our consumers should not have to pay the price for this. And so that's just something to identify. I would fully expect come May, they're going to kick the can again. They're going to extend it through the remainder of the fiscal year, and we'll be recoupled again, hopefully. But time will tell.
Okay. So that is your background on flood insurance. Yay.
Yeah.
Let's move on to another fun topic, GSEs.
Oh, yeah.
So for about a decade now, we've been hearing about how we know the GSEs have been in conservatorship, and we keep hearing about GSE reform. It's not happening. The House has passed a couple of bills, but it doesn't get through the Senate. Nothing really is being done. But now we're starting to hear increasingly, particularly in the business rags, about systemic risk and the potential that in another downturn, the taxpayers would be on the hook again for some pretty large losses. Can you give us a quick background on GSE reform? And then what type of changes does NAR want to see and why?
Yeah, so going back to 2007, 2008, when the downturn hit, Fannie and Freddie were finally on the line. We all understand that was bad lending practices, going out, predatory lending. Fannie and Freddie got in on that in the end because basically their shareholders were saying, hey, you're missing out on an opportunity to make me a bunch of money, okay? That led us to conservatorship, right? They don't want Fannie and Freddie participating in private market practices, right? Ultimately, as we all understand it, the federal government, as we see it as the association, our role is to guarantee the existence of really two things. One, the 30-year mortgage. Two, access to the secondary mortgage market so that, we can continue to keep this machine moving forward. Now, with that said, the number of bills that have been brought up in that time period to reform Fannie and Freddie have largely focused on the private marketplace. And if you go to the private market, you don't have a government-backed entity or a government-backed subsidy to push that mortgage back onto the secondary mortgage market. You're talking about a market that mirrors places like Canada, where it's 5-year balloon mortgages, where every 5 years you're refinancing. There is no such thing as a 30-year fixed rate mortgage in the private market. Why? Quite frankly, how many of us are actually going to invest our money in something for 30 years and only get a marginal return? That's just not how the market works. That's not what the market will sustain. And so only with the government backing can we expect to have those types of things. I mean, you could all imagine what would happen if your market changed to just even a 15-year adjustable rate mortgage, right? I mean, when we go talk to the banks and we ask them, do away with a 30-year fixed rate, what do you got? 15-year adjustable, right? That's the best that they'll do because they know over time interest rates will rise and they'll make a little bit more money here and there. It's a big challenge. Again, the legislation that has been proposed hasn't provided any guarantees. It hasn't provided a guarantee that the 30-year fixed rate will exist. It hasn't provided any guarantee that credit and the liquidity of credit would be, continuous in good and bad marketplaces. It doesn't have any guarantee for a 30-year fixed rate mortgage. And, we've had some of these things stated to us. Even the most recent legislation has taken steps down the roads to guarantee that, we would have those things, but nothing concrete in the bill says that the policies and procedures that we have today would exist, just in a slightly different format. And so, and most of it is, when you start reading it, it exists sort of as an ethereal world, like, oh, this is the way it's supposed to work, right? And until you start to move these pieces around, you don't really get there. One of the biggest issues that we wound up having was in 2014, the PATH Act came out, which basically said we were going to do away with Fannie and Freddie as they exist today. A lot of that conversation is talking about turning Fannie and Freddie into private entities, making them go out, find private backing to give them those funds. Again, these are all, bits and pieces and parts of the same legislation that keeps coming back to the table. Again, none of it provides any of the security that we have. And again, the affordability aspect comes in when you start talking about this. There is nothing to say that they would be able to cap fees. There's nothing to talk about, how these pieces are actually going to work clearly. And so there's a lot of challenge there. Most notably, and the reason this comes up now is because Jeb Hensarling, on his way out the door, decided that he was going to repropose basically the same legislation, slightly tweaked from, Jeb Hensarling was the author of the PATH Act. He went ahead and has reintroduced the bill through multiple Congresses now. He most recently renewed this legislation with some tweaks, again, guaranteeing the 30-year mortgage, but it wasn't doing it through the actual agencies themselves. It was just saying, like, yes, this will be offered. And he did it on the way out the door, but what was interesting about this is he actually had Democratic support from, what's his name? I forget his name, in Maryland, through a Democratic congressional leader in Maryland. And so now, now that we're starting to have this conversation, it's in a bipartisan fashion, it gives sort of a platform that we could start to look at this. So we're going to be paying attention to it, but ultimately we need to see another bill come up. And again, with everything that we have going on right now federally, shutdown being primary example, I don't foresee conversation there just yet, but time will tell. There's a lot of time will tell. Right?
So go ahead.
GSE stand here?
Go ahead.
No, I apologize. Government subsidized entities.
So, and Jeb Hensarling was chair of the House Financial Services Committee.
Yep.
He was from Texas. He's going back to Texas because he's tired of Congress now. He put out, during this entire period, the last, 2 to 3 years, I'd say easy, he was putting out regular videos, some of which I linked to at wemargad.org. You have to go back a couple of years to find them because during the hotbed of all this discussion that he was coming out with those videos. So if you want to go back and revisit what some of those discussions were and what he was spearheading, you can go and look at that to sort of refresh your memory of what all those debates were. So for us and the private mortgage, let's talk about the encouragement of private mortgage market. First of all, is NAR in favor of encouraging that, and to the point that are they working with lenders on this topic, the lenders associations on this topic, and do you want to encourage that ability for private markets to be able to come in and do this?
Yeah, I mean, we encourage them all the time, but again, it goes back to that question of, as a bank, right, and having investors, are you making the best decisions with their money? And, a lot of banks, they'll invest in the bond market side of it, but they won't actually invest in the 30-year mortgage. A lot of them, they'll do it if they can sell it off, but if they can't, if there's no secondary mortgage market, they're not going to deal with it. So for the banks that do offer them, they're great products. You often find, like most community banks, like the small community banks are the bigger avenue to get there. We do advocate it through the private market, but again, their attitude is without a secondary market backed by the government, we're not going anywhere near it. And that's just, there's no way you're going to be able to force the private market down that road.
Does NAR interact, I'm going to say substantially, with some of the advocacy organizations for the lender side of the fence to sort of work together and see what can be done, like the MBA or something like that?
Yeah, we have conversations with them all the time, but again, you're looking at it from an association standpoint where we're looking at, how best can we create a robust housing market versus from the position of, financial responsibility for their investors. And so, a lot of times we agree on things, but they're always going to have a different perspective when it comes to some of the long-term process. They support a 30-year mortgage, again, only with the secondary market so they can get it off their books. They're never going to carry it, and that's kind of the challenge. It's one of the big things that we saw, when the downturn happened is as, these requirements came up that, you had to keep a certain percentages on these books, they stopped actually sending most of those products out into the marketplace. And it was, truly small community banks who started filling
Yes, it was.
the back pages of those. So.
And unfortunately, in that process, the small community banks got a little whacked.
They did. But, one of the great testaments to this last Congress was some of the regulatory reform that they did that actually sort of, released some of the provisions under the CFPB and then under some of the other agencies for sort of the capital that these small community banks had to maintain. And so there was a reg reform bill late 2018 that wound up being passed that actually relieved that pressure so small and community banks wouldn't have the same financial reporting. Now, they still have very strenuous financial reporting to ensure that they're not doing the things that the big entities did, but ultimately it's going to free them up to really start to engage more in their marketplaces. And, you should be able to see that. Yeah.
Is one of the reasons banks sell their notes to other banks to get rid of the 30-year obligation?
No, it's to get it off their books and get a profit into their bank account, right? So if you think about it, right, like I'm going to take all Class A mortgages, I'm going to bundle them up, I'm going to push them off to the secondary mortgage market, which is the bond market, right? And someone's going to buy those, and they're going to take that long term because those projects wind up building roads, infrastructure, things like that, right? Banks need to make a profit fast, right? So they're going to get their 6% or whatever percent they're going to get on that mortgage that quickly, and they're going to sell it that way so that they can get a return. They can free that capital back up to relend. That's what winds up happening.
So on the secondary market, you're looking at people who want the stream of income. So they're willing to buy the discount, hold it, and live with the stream of income. But a lot of banks, particularly larger banks, they aren't interested in that stream of income. They're interested in the quick hit so they can keep moving. So it's just two different business models that you're looking at.
So you're saying that the original bank who made the loan at 6%, for example, sells it into the secondary, and secondary pay you that first guy 6%?
No. I mean, they'll pay them a percentage of it.
It's a discount, but it's still enough to make a profit.
Yeah.
So they want their quick profit now, right? And then part of what the secondary market is looking at is what is that percentage rate, because that goes into their stream of income calculations for long term, and that's where their value is.
Fast enough to slow down.
Yeah, so it's which business model are you operating on, and the two of them work together that way.
That's where the roads and stuff, and information.
I'm sorry, say that again?
So that's where we're getting all our.
Yeah, the bond. Yeah. People invest in bond markets, and they're expecting. Like we all have. I hope everybody in this room has a financial portfolio that's invested in stocks and bonds and things like that. And we look at those as long-term investments, right? So we're gonna, I'm gonna put my 401k or I'm gonna put a Roth IRA into, bonds, stocks, et cetera, knowing that the payout for that is X% over a long period of time, or that's what we expect that value to go to. Again, to the point that Liz made, when you look at that 6% as a bank, looking at it as an investment, I'm going to go invest my money here. How quickly can I get a return from my client, right? And that's what they're looking at, and they're hedging their bets on what I can get, hoping that they're going to get the best percentage of that. And then the bond market takes up the rest of it, and again, that pays off for the long term. And so, most big banks will go ahead and as they bundle their products and they find their mortgages and they detail their risk factors, they take all their really best products. That's the grade A product that they bundle up and send to the mortgage market. And that's what we're investing in 90% of the time. If you go back to 2007, 2008, they were doing a lot of predatory lending where people who are at much more risk of default were going in, they're selling these mortgages saying, hey, you're going to get your 6%, but it's really, a B-level mortgage. They bundled those together, put them as AAA mortgages, sent them off to the bond market, and the default rate on those was just astronomical. If you're not paying your bill, there is no percentage to actually gain a profit. So, yeah, shocker.
So when you look at portfolio lenders, those are the lenders that lend their own money. They take back that mortgage and they keep it. And so that's why you can go to a portfolio lender, whether it's a community bank or it's a credit union or it's some other private lender, and sometimes they'll say, we aren't offering that product right now. It's because they've used that pool of money they dedicated to that loan product. They've lent it all out. Now they have to wait for people to pay back so they can restore that fund of money. And then they'll say, after a few years, we're making those loans again. So the two different models, once again, of the way lending works. And part of what your client has to decide is, where are they most comfortable? What do they want to have? For some people, they are willing to pay a higher interest rate to be with a portfolio lender because they always know who they're going to talk to if there's a problem.
Yeah.
Other people are like, I really need that huge, massive marketplace to give me the discount in the pricing of my, or I can't buy a house.
Yeah.
So I'm going to go with the big guy who's going to sell it off because my discount pricing makes the difference between me buying a house and not buying a house. But it's something your buyers need to be aware of, and that goes into the math of who they choose.
Yeah. Yeah.
So there's a large movement now of the non-qualified mortgage ruining the marketplace because the QIS or the agency guidelines
Yeah.
become so conservative that it's cutting off, pipelines
Yes.
for certain buyers.
Yeah.
Is NR looking at that at all and thinking about the long-term impact's going to be from a legislative standpoint? That's sort of flirting with the same kind of path we went before we created this issue that caused the debacle in 2008.
Yeah, we are, and a lot of it is looking towards, and this actually gets to one of the questions that we're going to ask next, like what happens with the CFPB? How do they start to regulate that? And it will be interesting to see we're monitoring it, right? Like how much real uptake is there in the marketplace on these products? And I mean, it's a big concern because that's ultimately what led to the crash. When it becomes, and I mean, I guess we can just jump into it.
Go for it.
When we start talking about the CFPB and the regulatory entity over that now, they're paying attention to it because obviously, it would be interesting to see if Fannie and Freddie start buying those products up and start shipping them off and start backing them, right? And, that's the reason Fannie or Freddie instill in conservatorship, right? They do not want private gain versus public loss, and that's ultimately what wound up happening. And that's the reason we have this conversation about GSE reform is, trying to do away with that. It's still so new in the marketplace, and the percentages are still what they are. I think people understand where the risk is. What happens long term? I don't know. I'd be guessing if I told you, but we are aware. We are monitoring it. CFPB is definitely aware. They're definitely monitoring it. And by the way, in case anybody wanted to, under Mick Mulvaney, there was a change where they were going to go and call the CFPB the Bureau of Consumer Financial Protection. That went away. The head of CFPB, Kathy Kraninger, she's now decided like this is a fight we don't want. But yeah.
Yeah, but for about 2 weeks there, we were like, are we CFPB? Are we? Yeah.
Yeah.
And what it was is the name that Mick Mulvaney was going back to was the actual legal name of the entity under the law. He said, let's be legal with our name. But what that means now is that people know it as CFPB. Mm-hmm. So one of the things that Kathy Kraninger, and she just did that, a week and a half, 10 days ago, something like that.
Yeah, very short.
She just said, no, everybody knows us as CFPB. We're going to keep it there. We'll live with the fact that we're slightly not our legal name.
Yeah,
It'll be fine. So when Mick Mulvaney came into CFPB, it was right after Richard Cordray. And Richard Cordray had one of the things that was happening in the marketplace, if you recall, we had a real pullback in product offerings, and we had a lot of scared people, entities, whether it was title companies or realtors or it was lenders, a plethora of people, because he would unilaterally punish people. So the big example of that was PHH. And PHH was accused by CFPB of violating some parts of RESPA, and they maintained they did not violate those parts of RESPA. What happened, though, is that their administrative judge came through and said, well, we think there were some things that you didn't maybe not technically violate, but you violated at least the spirit of it, so we're going to give you a penalty. And Richard Cordray went through personally and increased that penalty by $100 million. So, yeah. So that led to the lawsuits, and that was the type of environment that we were in. So let's talk about when Mick Mulvaney came in. He started saying, we're going to be more consumer friendly, more industry friendly, as far as telling you ahead of time what we expect and our guidance. We're going to actually give you guidance rather than come back to you later and say, oh, you did something we don't like. We will tell you ahead of time what we expect. Is that really what's been happening since he took over and now that Kathy Kraninger is here?
No. I mean, he tries to, I will say this. We had a really good relationship with former Director Cordray. He was very upfront with us about things, and, they took a lot of feedback. for the banking side of it, for the lending side, they were absolutely fearful of Cordray coming after them regulatorily, winding up in massive lawsuits with massive fines. But good, bad, or indifferent, I mean, he was very upfront with us. And so we had a good working relationship with Cordray before he left in November of 2017. Now in the last year, we've been working with Mick Mulvaney. Mick Mulvaney is very much like, I got you, and very less upfront and clear in what they're doing and the changes. But we do know, and there is a lot of clarity that, there's going to be less legislating by regulation, as opposed to, regulation by legislation. And so, it helps to free up the banks to say, okay, hey, look, you're not going to be doing, we're not going to be coming after you with a regulatory reason. You're not going to wind up in court, theoretically. Just do the right thing. Really it boils down to the last year has kind of like opened the door. I think that's why you see a lot of those, QM loans being made or non-QM loans being made. And Kathy Graninger, look, let's just be honest. She was put in there because she can be controlled. It's honest. It's true. Mick Mulvaney still has his thumb on her. We'll see. We're supportive of her being there. She is a very pro-business individual, so we expect it to be good. But I'll be frank. She's there because she can be controlled. So the one big piece that Mick Mulvaney was trying to push for that we're actually against, he actually wanted the CFPB to actually wind up being subject to Congress, which we are vehemently against. And the reason for that is we just don't want this agency to become political. We don't want it to be subject to the discretion of whoever's in power at that time. It should function as a protection for the citizens of the United States, for taxpayers, et cetera. And the worry is that, depending on who comes in, they start playing around with budgets, they start changing up staffing structures, they start doing other things, it becomes a big problem. So, we'll see what happens. There's still 2 more years of this presidency. You still got, Mick Mulvaney heading up OMB. You have now him as the acting chief of staff for the president. So a lot of things could still change. We will still continue to try and weigh in with Kathy Graninger and try and, maintain some of the changes that are there because we do think they're positive.
Great. So we have just a little bit more time. So I'll make sure we get to NAR in 2019.
Yeah.
Give us an update on things that you're looking at or concerned about in the 2019 legislative session.
Yeah. So the big piece, first and foremost, is going to be the impacts of the 2017 tax reform bill. January, February, that's when you all start pulling your receipts for the previous year. You start going to your CPA. You start looking at the books. How am I going to do on my taxes? We're really interested to see how people, weather this one. And the reason I say that is, there was a really interesting dichotomy between the feedback that we were getting. Some of our members loved it, right? Arizona is going to be one of the states that, you really probably wind up benefiting from the tax proposal. And then you had the big headline states. You had New York, you had Maryland, you had California, you had the Massachusetts, New Jersey. But, they're going to be negatively impacted. But then there are other places like Omaha, Nebraska, and other small, big city communities where all of their revenue is based off property taxes. The average property tax bill is in the tens of thousands of dollars. And now they're looking at, having limits on what kind of tax deduction that they're going to get through SALT. We're going to really be paying attention to what that impact is. In addition, one of the things that I would tell every single one of you is, your part of the 2017 tax bill includes a 20% deduction for pass-through income, and meaning this is income that you pay to yourself through your business, right? You're going to get a 20% deduction off the top. Simple math: you made $100,000. If you paid yourself $100,000 last year, take $20,000 off the top of it. $80,000 is what you're going to report in taxable income, right? So that's a big number when you start looking at your tax bill. It's something that we have followed very closely on making sure that, you all were included in that to, gain the benefit. Now it's going to boil down to what does your structure look like, right? And so going and looking at your state laws and figuring out what those structures are going to be is going to be duly important, and it's going to tell us a lot. One of the things I would say is, going back to the features, which I apologize, we didn't finish that.
No.
NAR.Realtor, when you go on there, there is a series of tax videos by Evan Lydiard, who is our tax consultant, or he's staff tax person. go on, watch those videos. Those are going to tell you a lot about probably a starting point for questions to ask to your CPA, but more importantly, it'll just give you a compass to sort of follow. That's going to be the big piece that we bring up first. Obviously, GSE reform, because of the way Jeb Hensarling brought it in towards the end of the year, that's going to be another big piece that we watch. Again, we don't know what kind of legislation will be proposed. They may go ahead and just reintroduce the legislation that they introduced at the end of the year. Time will tell. We'll see. NFIP, obviously, that's going to be probably the very next thing that we're going to be paying attention to, just given the timeline of May. We've already got that countdown clock rolling again. One thing I would say, and you and I were having this conversation last night, was, we're going to go ahead and approach calls for actions in a very different way. We're going to start carrying very targeted messaging to very key members of the legislature to try and make sure that, we're not necessarily yelling fire when we don't need to be yelling fire. A good example of this was, in December. A lot of times, you all, depending on the states you're in, sometimes it's louder than most, reach out knowing this deadline's coming. Everybody in this room now knows that May 31st, NFIP is going to sunset, right? Okay, so we need to deal with that. If we don't have something by May 31st, people in this room may be calling me saying, hey, what's going on? Why aren't we doing a call for action? And the reason we may not be doing a call for action is because we know behind the scenes the deal's already getting brokered, right? No reason to go out there and do that. And so you can't go out and publicly say that, but at the exact same time, we know what we need to do. We know the people that we need to lean on, and there may not be a reason to rile up 1.3 million members to get 20, 30, 40,000 of them in a respective state to come out and start, beating the drum. So we're going to start doing much more focused efforts in the legislature to try and help get some of these things through, and then ultimately try and broker some better deals for the long term.
So circling back around to the tax reform and how it may affect you, during that time period, originally real estate agents and brokers were not part of that ability to have the pass through, and NAR went through and it got us included in that. At the time, I was linking at WeMARGAD.org to the discussions, to the written pieces that NAR was producing. So if you want to go back and sort of refresh your memory about tax reform, you can go back to WeMARGAD.org and read those articles and see some of those videos. And I believe, if I'm not mistaken, I'm going to say somewhere earlier this week, NAR just released a one-sheeter on that 20% pass-through that you might want to go look at and consult on. And it was a real good thing you can take to your CPA and say, okay, I'm reading this. What are we doing here? And he's right. You may end up, after this tax year, talking to your CPA or your tax attorney and deciding you need to change the type of entity that you operate under. That is a real concern. So we'll see how it plays out. This is a first try for this.
Yeah.
So look into that.
Yeah. On a couple of other topics, just to make everybody aware, I apologize. I'm referencing our 2019, which I do not have committed completely to memory yet. But it's some of the standard stuff. We'll be looking at infrastructure projects because that's a big one. We're talking about our roadways and our infrastructure. There's going to be some big changes there. We'll see what the conversation looks like as far as infrastructure is concerned. You have a new Congress, so it'll be interesting to see where their priorities lie. Particularly important for real estate professionals is association health plans. Obviously, we know the cost of health insurance is not going down, it's only going up. Last year, we were very successful in getting a Department of Labor revision that benefited us, which actually would include members of like groups, meaning real estate agents, to be able to actually join together to form an association health plan. Now, with that said, we are currently right now waiting for the result of a lawsuit where 12 states who are concerned that an AHP would, and this is a bipartisan effort, Republican and Democratic states are dealing with this. They are actually suing because they're worried that the creation of AHPs in their state would actually undermine their ACA programs. And so ultimately, we're waiting for the result of that case. That case could have dramatic impacts on whether or not we actually are able to do that. But second to that is the challenges that we have with the demographics of our membership. And this is no jab at anybody in the room, just look around the room. What is our average age? Roughly 54 to 56 years old. If you look nationwide, what is our percentage of members, male to female? It's roughly 60% women. You take those demographics and you walk them over to an insurance company and ask them what a association health plan would look like. It's actually probably more expensive than the insurance you're paying for today. So it's a challenge, and it's one that we're going to have to work through, or we're going to have to get very creative about. The short answer is we don't have a complete answer for you today, but we hope to have something in the future, and we hope to be able to work towards something in the future. But it may be something we have to deal with it on a smaller scale.
Great. Well, our time is up. Thank you all for coming, and thank you so much, Jack, for
Yeah,
coming and
thank you so
talking to
much.
us.
Appreciate
Make
it.
sure you get Jack's card, his information, and you can keep in touch, and he'll make sure you know what's going on, okay?
Do what I can.
We're going
Thank
to
you,
come
everybody.
back in 10 minutes.